Hello, everybody. Welcome to 100-Year Real Estate Investor. We're your host, Jake and Gino, and this is the show dedicated to long-term personal financial engineering. Gino, how's it going?
Doing good, Jake. In the house.
In the house in Florida today, making it happen. Today, we welcome back our co-founder of the 100-Year Real Estate Investor, Teresa Kuhn. Teresa has been working with whole life policies for over 30 years. Her and her team bring over 100 plus years of experience and over 1 billion, that's with a B, in generational wealth created. She's a bank on yourself professional, an expert in infinite banking concept, and specializes in working with real estate investors. So without further ado, Teresa, welcome back.
Hey, so great to be here and loving close physical love you guys got going on.
You know, he's got this ring of death light up here, and it's kind of warm. It's in Florida. I'm not used to this. I'm sweating a little bit, but we're going to get through this. Okay?
He's out of his element right now. I'm going to try to bring him back into his element right now.
Okay. All right. We're bringing it back around. So Teresa, because our design work is specific to the real estate investor and the dual asset strategy, please explain why all whole life policies may not be created equal when utilizing the dual asset strategy.
So there are a couple things. Let's start in the world of life insurance as an asset class, because that's really what we're talking about. We're talking about an asset class specific to using life insurance, not just for life insurance, the death benefit, but also as a saving strategy and as a strategy for our real estate investors, where they can put money into a policy and then use it, dual asset strategy, into investing in their real estate. So in the world of asset class life insurance, there's whole life and there's universal life. And in those two different worlds, right, we are using a specially designed whole life insurance policy for our real estate investors. And we choose not to use an IUL under the world of the universal life because it may not work long-term the way our investors want their policies to work.
Mm-hmm. Why is that?
Okay, let's dig deep. So with whole life insurance and the whole life insurance policies that we work with, very specific, right? They have guarantees, they have fixed insurance premiums. The growth is dependent on the profitability of the insurance companies. We work with very, very specific companies. They're mutual insurance companies. And by definition, a mutual insurance company is there to share the profits with the policyholders. Mm-hmm. Most insurance companies out there are owned by stockholders, and a company that's owned, by their shareholders, their objective is to create profits for the shareholders, for the stockholders. So the owners of policies with a stock insurance company are really not on the same side, right, in terms of objectives. So the mutual insurance companies that we work with and with the whole life participating policies participate in the profits of the insurance company.
I think the importance there is it's an alignment of interests with the mutual owned companies. Wouldn't you agree?
Totally alignment of interest, right? And so it's not about creating profits for shareholders, because at the end of the day, what do you think those companies are thinking about when they're going to credit policies when they've got a competing interest to the shareholder, right? And what do you think a mutual insurance company is thinking about when it's got to participate with the profits of their policyholders? I use the analogy all the time of banks owned by shareholders, right, by stock-owned banks, and credit unions. Credit unions, by design, are there to benefit the members. Banks are there to benefit and profit the shareholders. And so who would you rather bank with, right? Of course, a credit union. You're going to get more benefits because those profits that are generated, and I use profits in quotations, that are generated inside the credit union, they go back to the members in the form of more benefits. I'll tell you a crazy story. Back when I lived in Washington, D.C., we were a member of the Pentagon Credit Union. We weren't working for the Pentagon. I don't know how that happened, but they had a crazy deal. You could take out a loan, 0% interest for life, and there was no end to that loan that you took out. So if you took out, $20,000, you could pay it off in 10 years, 20 years, 0% interest. Now, if you think about it, how crazy is that? But that was a benefit that they gave back to the members because they had so much profit that somebody came up with that great product. 0%, indefinite, however long it takes to pay it back. Crazy. Now, a universal life policy, and really the type of policy that we're talking about is the indexed universal life policy, which falls in the family of ULs, right? An indexed universal life policy, the credits, the growth in the policies are not guaranteed. They're linked to the equities market, the stock market, right? Insurance premiums are not fixed. The cost of the insurance can and does go up every single year. The growth, of course, is dependent on the market and how they're always illustrated. You see the performance go up every single year. There is never a down year. So if an IUL policy is projected or illustrated to show 6% growth every single year, they're not showing you 6% one year, 4% another, 3% another. They're showing 6% every single year. Now, how can they get away with that? Why do they do that? Because there's misinformation out there that says the stock market grows 6% a year, at least on average. Well, average is that really tricky term that they use, right? What they're not showing is that there is a sequence of return risk, which that means is when there are down years in the market and your policy gets 0% credit or 1% credit and your cost of insurance goes up and you've taken money out of your policy to go invest in real estate, bad things can happen. And those values accelerate in the wrong direction.
Yeah, and to do the dual asset strategy correctly, we need certainty. Can't have something that's up and down. We need to know that it's going to be there. It reminds me of these silver commercials I'm seeing right now, Gino. There's all these silver commercials out there saying, well, if silver only doubles right now back to its all-time high, you'll make 100% return. Literally, they're out there saying if it only gets back to its all-time high. And so they're pushing this stuff. And it's just, you got to be careful with the marketing. I think that's where you can get caught. And if you're specific and you know that you want to execute the dual asset strategy, you want to do whole life to put it into real estate, you need to know that the money's going to be there and you're not gambling with the markets at that point.
Teresa, let's dive into this presentation that you've created for us today.
Okay, so we talked about whole life versus IUL. Let's talk about why IUL doesn't work for that dual asset strategy. So what is the dual asset strategy? You guys have done a great job explaining that on many of the podcasts and webinars. It's basically taking $1 that you would normally invest directly in real estate, but you position it in a policy, in our whole life policy first, and then borrow the money out to invest. So you've got two assets working for you at the same time. I would also position the dual asset strategy as meaning you've got a life insurance policy with a death benefit, and you've got the growth with the cash in the policy to use that's growing tax deferred, and you can tap into tax free in the future. So there's so many different options and ways of using our dual asset strategy. Whole life is the only one that will work that way. The IULs do not give you any control. At the end of the day, the way the IUL is designed, the insurance company makes all the rules. They tell you how much crediting, the maximum crediting you can have on the policy. They tell you how much the insurance is going to cost. They give you the provisions for the costs and the fees. And basically the analogy I use is, it's like playing Monopoly with someone. And when they might be losing, they get to change all the rules, right? And you are the one that takes responsibility and has the risk of the policy performing with someone else that's making the rules. How difficult is that? And why would someone, and we're talking about an asset class, life insurance, right? It's supposed to be safe and secure. Why do people mix an asset class with risk and someone else controlling the rules with safety, something that's supposed to be safe? It just doesn't make sense. Whole life insurance guarantees. The company does what it says it's going to do. It's got a tremendous track record of doing it since before the Civil War. And you know what the rules of the game are. day one. No one's switching them on you.
I think we've been trained to put every single one of our dollars at risk. And that's what people are doing with IULs. They're saying to themselves, well, I've got this money here. I need to get a rate of return on these dollars. So I need to put it into risk. I would just put a word out there. If you're going to invest in the stock market, invest directly in the stock market where there's no caps, where you control your trades. Don't put it into an IUL policy where, hey, I'm getting insurance, but I'm also getting the stock market. Spread them out. I like whole life policies because I need some of my dollars to be working. It's whole life for life. So I have a living benefit and I have a death benefit. And you're talking about control here. This sounds as if we're discussing the 401k, which was another thing that was contrived by the government back in the 70s. You don't really have control. The rules can change and it's not really your money. It is your money, but until you retire, you really can't tap out of that money with certain exclusions, obviously, but the rules do change. So it's very eerie how similar the 401k is to IULs. If you're going to invest in the stock market, take that bucket of money, invest in the stock market. If you're going to invest in buy an asset, invest in the asset of whole life, just invest in that asset of whole life and then use the dual asset strategy to borrow your money out and to place it into another asset.
We have been programmed. It is programming. I want people to wake up from the trance of the programming that says, if your dollar is not giving you a return, if you have not risked that dollar, then you can't create wealth. Mm-hmm. There is a place and there are strategies to create wealth. And just as importantly, there are strategies to preserve that wealth. Mm-hmm. And this is about wealth preservation. This is about having money in reserves that is in a safe place for like your CapEx accounts that you guys talk about with your real estate, for emergencies, for whatever life throws your way. It gives you options. You know, a lot of people, and this is something that I found, Jake and Gino, in your community, I mean, amazing, amazing community, but a lot of the students there, a lot of the community members, they're young. They didn't live through, you know, the ups and downs of the real estate. They didn't live through 2005, 6, 7, 8, 9, 10, right? When a lot of real estate investors were struggling. They haven't lived through the market going down. They haven't lived through crypto, you know, crashing, right? Wait until that happens, right? It's a huge awakening. And
before we go to the next slide, I really want everyone to write this down. We had a podcast with a gentleman named Andrew Cordell. He talks about the rules of money. It's really about the rules of money for the wealthy. 3 rules that he mentioned to us was the first thing is we need to create the money. The second thing is we need to keep the money. And the third thing is we need to protect the money. So we've already created the money as the wealthy because wealthy have that wealthy mindset. It's not about how much dollars you have, but it's about the rules and how you're following those rules. So you've created that money. You need to keep your money and not risk every dollar like Teresa's talking about. And you also need to protect it. So a whole life is an amazing vehicle to be able to protect your wealth and also to deploy it when you have an opportunity out there. Try doing that with a 401k when you're 43 years old and you've got $500,000 there. Very difficult to pull that money out of a 401k, but if you've got that money sitting in a policy, a lot easier to pull that out and to utilize those dollars.
I think we need to get clear on it because I think we're almost comparing it to a 401k, but
No.
really what we're comparing it to is our bank account. We're replacing our bank account with the whole life policy. Okay. That is a cash management tool that will give our family a death benefit and also allow us to take those funds and put them into real estate while it's growing much more aggressively than in your personal bank account. I think that's the mentality we have to get to. We're not interested in investing in stocks. We're not trying to get greedy and put the money at risk. We need the money there just like it would be in your bank account. It doesn't go in your bank account. It goes in the whole life policy. We then take those funds, put them into a real estate deal. And on the back end, we're rewarded with the death benefit. That's really where our mindset needs to get to with this.
I like that.
Your savings deserve more.
Yeah.
You know, most people would agree they need savings, right? You can't assign every dollar a job to chase risk. The dollars that you have assigned to go to savings, those savings deserve more. And guess what? You can get more with the whole life policies.
Love that. So the first one's control. What's the next one?
Next one is the IULs give you no guarantees. They show you these rosy, linear, positive returns every single year, 6% a year. And the reality is Wall Street will say, on average, that's the tricky term, on average. Well, how does average really work, right? Average means that there's going to be years that you don't get 6%, you might lose 6%, you might lose 10, you might lose 20. And yes, with the IULs, you don't have any negative years. But because your cost of insurance goes up, and because the cost of borrowing money, right, is going to be there, your values can go down, and they can go down to a level where you've got nothing. Very, very interesting. I had a phone conversation yesterday with a gentleman who's been in the business as long as I have. He was actually a professional athlete. I won't say anything more. And he's in our business. And he called me, asking me questions about whole life insurance because he sold a lot of IULs. And, really it was a conversation about whole life and IULs. And I gave him my opinion. And I said, frankly, this is the challenge you have in your practice. The challenge is you've got to help your clients manage every single one of those policies and pray that they do not lapse in the future. Because you know what happens when those policies lapse in the future? There's a huge tax bill.
Mm-hmm.
And he told me flat out, I wish that I knew what you knew way back when you started. I have sold a lot of IULs, and that keeps me up at night because I know these policies need to be managed. And you know what? What if 5% of his clients fail, right? His policies fail. Out of, a very successful career, maybe that doesn't sound like a whole lot, but that 5%, that individual 5%, they had dreams and expectations from their policies performing that fail. And an advisor that cares about their clients, a financial professional who cares about their clients, doesn't want to see one policy fail.
Love that.
So guarantees, guess what? Not very sexy. Doesn't sound very sexy when you're looking at some great returns, but boy, is it sexy in the long term.
It's the
What are we
mindset.
about? Long term.
Mm-hmm. Yeah. Number 3.
No liquidity. So from a short-term perspective, want to make sure this is set up correctly. From a short-term perspective, index universal life policies may restrict your ability to borrow against the cash value short-term, right? Our specially designed whole life policies can provide greater liquidity than the IULs, especially in the early years.
Excellent.
Yeah, and here's the deal: if you can't get access to the liquidity, you're not performing the dual asset strategy. You don't have access to your funds. You're not going to be placing those dollars in real estate. That's the huge difference.
You got it. You got it. When it comes to flexibility in terms of premiums being paid, flexibility in terms of if you want to stop paying premiums or not. With whole life insurance policies, we've got, I'm going to throw out some technical terms, we can reduce pay up the policy where basically you're closing the door. So no more premiums ever need to be paid. And you can reduce the amount of premiums that you're paying into the policy to accommodate whatever you've got going on. And so in terms of flexibility, when it comes to, our real estate investors, many of them are stealing from Peter to pay Paul. They're making deals happen, and they've got just a lot of moving parts. With our designs, we give our clients a heck of a lot more flexibility than an IUL could ever give. Protection, when it comes to protection and the policies, we talked about this. Why would you want to mix risk with what's supposed to be a safe money strategy? And I think it goes back to what is safe money? What is a safe money strategy? For me and what I teach my clients, you assign every dollar a job. And the job for your savings account is not to mix risk with that savings. If you look at a financial pyramid, these policies sit on the bottom, right? The foundation of someone's personal financial balance sheet. And this isn't just us saying this. Look, the Federal Reserve, when it comes to their member banks, have basically restricted Tier 1 capital, which is the bank's reserves, to safe money strategies, safe money accounts. And we've seen those numbers. The banks' balance sheets, and you guys can look this up, a lot of banks have more money in this asset class of life insurance than they do in equities and real estate. Why don't they promote life insurance as an asset class? Because they want you to bank with them. Why? because they give you a lot less than our policies do for your savings. Your savings deserve more.
Yeah. So he talks about creating, little money soldiers. Like he views money as little soldiers. And I feel, to me personally, the role of this money, these dollars specifically when in whole life, is the shield. You're talking about protection. Okay. Not only are you replacing this, your bank account with this, but you're also getting asset protection as well. Those dollars are more safe than they would be in your bank account from creditors and things. So I think that's very important. Plus, you're protecting your family long-term because of the death benefit. Do you want to talk about the asset protection at all that's associated with whole life?
Absolutely. There are many states that will allow you to protect the cash value and the life insurance in these policies against creditors, against bankruptcy, against lawsuits. There are a number of states that don't, but most states do. And it is very state specific, but I'll tell you about like Texas and Florida, whatever money you've got in these policies, creditor can't go after it. You remember Enron and you remember O.J. Simpson?
Mm-hmm.
Well, who was it? Ken Lay in Texas. When he died, his wife had a lot of money in life insurance that she was able to tap into because Texas had those provisions where your life insurance is creditor proof. O.J. Simpson, huge lawsuit, right? He was in Florida. That asset was protected.
It's interesting though, because you think about it like it's your shield. Like this is out of your soldiers. This is the shield. This is the protection on multiple levels. And then the asset that you put it into, those are the troops storming the beach. Those are the ones out there chasing the high yield. So it's working together. It's really a mindset shift. If you can get your head wrapped around this, how each dollar has a specific job. And this is more the troops protecting the wall. They're on the castle wall protecting. The money going into the assets, those are the ones storming the beach. It's just a different mindset when it comes to that.
So Jake, what you're talking about, what Mr. Wonderful's saying is that we are all generals. You have to be the general and your dollars are the soldiers that are going out to war. Yeah. So every dollar has a specific job or specific duty for it. And not all of those dollars are going to be risked at war. That's right. You're going to have some back for the supplies. You're going to have some back for
protecting the wall,
whatever that may be. And I think you need to deploy them, and not every one of them has to be at risk, and you want them to come back from the war, and you don't want them all to die. So I think this is the analogy, and I like the analogy because it really makes it seem really important that every dollar means something. So if you're actually using this for cash management and you do have it in the bank, it'd be much better off in this policy because you're making, on average 4%. Whereas in a bank, you're making 0.2% if you're lucky. Plus, like Jake said, this is a truly protected asset. You're thinking long-term for this. This is not only going to be, now you're long-term, and you have the ability to take that out and to deploy that money elsewhere.
Yeah. So it's really serving two functions. It's giving the protection. Plus, when you deploy the dual asset strategy, you're also going out there and putting it into an asset for growth.
Love that.
I love the analogies. I use the analogy of the last man standing. This is your last man standing, right? Why would you choose a product, a strategy that has risk for your last man standing? No, your last man standing has to stand on high, solid ground. You've got liquidity, use, and control of your money. You've got options, right? Since we're talking about military analogies, I'm going to use another one that I've used a lot, which is this is your financial battleship.
Yeah.
What are battleships designed to do? Navigate the seas, the oceans, the world. And when there's trouble, they have so many contingencies built into that battleship because they know there may not be anyone out there to save them, right? Or give them supplies. This is a financial battleship, navigating the oceans, the storms of life, the good times, the bad times, no matter what happens. This strategy gives you options.
Teresa, you're speaking my language now. Let's talk more war.
Okay, so index universal life policies really don't have a proven track record. And then we're going to say, well, they've been around 30 years. Okay, they've been marketed for less than 30 years, but here's the track record that they rely on. Historical performance of indexes of the markets, right? And so Some would argue, Wall Street, the markets have done, whatever on average forever. They always come back. The markets may go down, but they always come back. Whole life has been around. And the companies and designs that we work with, right, since before the Civil War, they have always paid a dividend to policies. They have never missed a year. And we're talking about world wars, Great Depressions, Great Recessions, great inflation, ups and downs of the markets. They are consistent and they deliver. When interest rates go up, dividend scales go up, right? And we've been in a super low interest rate environment for a very, very long time. You know what? What does that mean? Interest rates are going to start to come up. Dividend scales are going to start to come up. You talked about, Gino, 4%. Overall, our clients can expect anywhere between 4.5% to 6% tax-free. It's tricky. It's tax deferred, right? But if you use our strategy, you're not going to pay taxes on that growth. And when interest rates go up, those returns are going to be greater.
I love that.
And so we've come to the end of our presentation. And, Jake and Gino, it's been such a pleasure co-founding the 100-Year Real Estate Investor with you guys. There was such an alignment of values and philosophy and long-term thinking, which is why we knew this would be a great partnership. But it really is about bringing to the real estate community a team of financial professionals who have worked with this concept and this design for almost 100 years. When we talk about that we have placed over $1 billion of life insurance, that was of the day that our client started the policy. That's the only way that we could define that number. We had billions of dollars in life insurance current that our clients have used. Our experience is unparalleled. And it's not only important to design and get the policy issued correctly, it is just, if not more important, to have professionals that can guide you in managing these strategies and these policies, especially with real estate investors having so much going on when it comes to their finances. The financial battleship, right? Who's the captain of that battleship? Who's guiding, the battleship?
I just love it because I am a huge student of personal finance. And that has nothing to do with the stock market. Everyone out there thinks personal finance, stock market. Look, I love this stuff because I've set my life up by design. It's personal financial engineering. I use a spousal lifetime access trust, personal property trusts. Okay. There's a design to how my money is being utilized. I have a holding company. This is all a part of it. And in addition, using the whole life for that protective shield while my assets are going out there to war every day. So it really is a mindset. If you want to do the best for your family, I think there's structures and ways as Americans that we can set ourselves up for success. You can either be the Vanderbilts or you can be the Rockefellers. If you don't know what I mean, look it up. One family is still extremely wealthy and has created amazing generational wealth. The other has not. You know what? I'll just cut to the chase. The main difference was whole life insurance and how they set their trusts up to work with whole life. So look, if this is the kind of stuff that you're into, I think there's a great opportunity for you to do it the right way, utilizing the dual asset strategy, being safe and secure about it, and doing it in a way that's going to be there for the long term for your family.
What I would challenge everyone to do is there's the QR code, scan that QR code and schedule a call with one of the 100-year team members. It's really important to further digest. Remember, people see the world as they are, not as it is. So, you may not be educated on all of these different strategies, but you have the ability to learn more about the differences between an IUL policy and a whole life policy and see which one is right for you. I mean, that's what we're there for. We're there to educate our community. So you can either go to the dualassetstrategy.com or you can scan the QR code and set up a call with one of our team advisors.
Wonderful. Teresa, thank you so much. Always a wealth of knowledge. Love the military analogies. It made my day. Thank you so much.
Thanks, Teresa.
My pleasure, guys. Take care.